Hey, so in this video, I want to show you how we help the client rapidly grow their business value to over $1 million within 3 years. I want to share with you the simple statement framework that we use, the 3 key metrics that we track, and how we do it so you can do it too. So if we haven't met yet, my name's Jason. I'm your favorite non-traditional accountant, helping business owners just like you dramatically build company value. So with that in mind, let's jump in and I'll show exactly what we're talking. If you want a copy of this dashboard, just let me know and I'll shoot it over to you. So unlike traditional financial statements that are hundreds of lines long, a lot of comparisons, this is the simple statement framework we use to get started to let us know where we need to dig a little deeper. So there's really 3 numbers that we look at, and the setup is really straightforward. So we just use a rolling 12-month P&L. We want to limit seasonality. Use a current balance sheet pulled right from our accounting software. We want to adjust our owner or owners' wages to make sure they're a market wage. We don't want them to be underpaid or overpaid in this analysis. We want to remove labor from our cost of goods sold. And then if there are wage taxes and benefits in the labor line, we want to remove that. We just want a raw gross wage number. So the 3 numbers that we look at are our labor efficiency ratio, our return on invested capital, and our cash growth ratio. So our labor efficiency ratio is our gross margin dollars divided by our labor expense. So what we want to know is for every dollar of labor, how much gross margin dollars is that driving? Right? We want the green zone between 1.9 to 2.2. Traditional businesses, when that gets above 2.2, we know that our labor is being overutilized. We're going to have to make an investment in our labor or efficiencies to bring that number back into track so we don't overextend anybody. The second number we look at is traditional return on invested capital. We want to make sure that at least is above 50% to be sustainable. Preferably our green zone is above 75%. And then our cash growth ratio is an interesting calculation. It's our net income divided by revenue compared to our trade capital as a percent of revenue. And so what this tells us is, how much cash are we going to need to fund for every revenue dollar growth? So in this example, this is 19%. So what that's telling us is that we're not going to have to fund any of our receivables or inventory. Every dollar revenue is going to be self-funded. We can actually take, in essence, 20 cents out in cash flow. So we want that to be as small as possible, particularly greater than 0. So for a summary, for a business that we helped, this is an older, dirty business that a gentleman bought at the end of 2020 for $100,000. If you look at it, the labor efficiency was 1.4. The return on capital was 8%, and any revenue growth was going to cost him 20 cents in cash to fund that dollar labor growth. So we started working with him at the end of 2021, able to make a little bit gain in efficiency, our efficiency ratio, return on our investment. But we really saw those returns start with a full year of working together in 2022 and 2023, right? We were basically able to get this to really operate smoothly in 2023. Now, the most important part for us is that, he bought a $100,000 business, but in 3 years, from 21, 22 to 23, he was able to grow that business to over $1 million. And he's actually taking out over $350,000 in income each year. So looking at these 3 ratios together, they're really powerful, and it shows you exactly where to focus your energy on. So I hope you like that. And if you want a copy of the video, just drop me a link, a comment, and I will shoot it over. Thanks, and take care.